today. So with that, we'll go ahead and get started. We decided to start what's hopefully going to be a regular communication and webinar series with basically the fundamentals of endowments. We've done several other kinds of workshop-y things and or presentations, but this is one that we heard loudly and clearly a lot of questions about, and how do we make decisions, and how does this endowment work, and oh geez, we just get a check, or we get money in our bank account every March. We don't really know where that comes from. So we're hoping today to answer a lot of those questions. But as Kathy said, when you complete the survey, please let us know if there's additional things that you'd like us to make presentations on, or like more information about, things that you think went well in the presentation, things that you think we need to improve on, because we really take that information to heart and we want to make sure that we're meeting your expectations and needs. So we'll get started with endowments. Montana Community Foundation's mission is creating a culture of giving so Montana communities can flourish. We are all about Montana's future. And you all may know, who have been acquainted with us for a number of years, a big part of our focus is capturing the transfer of wealth that's occurring here in Montana to make sure that the things that people love about our great state are supported forever. And the only way that's really possible is through permanent funds and endowments. Endowments are kind of unique types of funds because they are here forever. And there are a whole bunch of legal requirements around the technicalities of how endowments have to be administered. And our organization really prides ourselves in making sure that we not only know those laws, federal laws, state laws, but we're actually following and are in absolute compliance with those laws and requirements. People who make contributions to endowments are able to reduce some of their income tax situations and their estate taxes, and we'll talk a little bit about that later on. From the nonprofit perspective, one of the reasons endowments are so important is they are that one source of operating revenue that is something you can always count on. And I think now that we're all like living through this pandemic, this is becoming more relevant than ever, because as one nonprofit executive told me, we're one snowstorm or ice storm away from not being able to fund our operations in a given year because we rely so heavily on special event income. Endowments are one way to stabilize your stream of operating revenue because they are permanent, they are here forever, and they are legally inviolate. I think I also mentioned earlier this intergenerational transfer of wealth. We know through the research that we have conducted and sponsored that there's a huge amount of wealth passing from one generation to the next. And if we're able to capture just a small portion of that wealth for the betterment and future of Montana through endowment growth, it's amazing the kind of support that can go to our nonprofit community. So that's why endowments. Montana is one of very few states in the United States that actually incentivize gifts to endowments. We actually have on the books of Montana's laws, the Montana Charitable Endowment Tax Credit. You might have seen it referred to in our publications as METC. It's basically a credit, which is, for those of you who are accountants, it's an above the line recognition of something someone has done for the benefit of charitable purposes. And so it's different than a tax deduction. It's actually a tax credit. In order to qualify for the Montana Charitable Endowment Tax Credit, there's a certain form that a gift needs to take. And if it's a gift coming from a corporation, it can be a direct gift to a qualified endowment. All of the endowments at the Montana Community Foundation are qualified endowments. If the gift is coming from an individual or a couple, and that couple wants to take the Montana Endowment Tax Credit, they have to make that gift in the form of a planned gift. So a charitable gift annuity, a deferred gift annuity, those types of gifts. And our team at MCF are highly capable and competent and well-versed on administering those technical planned gifts. In fact, I was just looking at some of the data. We have almost 600 planned gifts that we are currently administering. And when you look at the total number of funds that we have, it's almost half of the funds that we have are being administered through planned gifts in terms of the number of funds. So we're very astute at how to administer those, and we can be your partner in the process, helping you grow your endowment through tax credit qualifying planned gifts. One of the things that we pride ourselves in is knowing and developing systems and processes that ensure that we follow not only federal charitable gift laws, but also state laws. And so Montana, in addition to having the charitable endowment tax credit, we are what's referred to as an UPMIFA state, Uniform Prudent Management of Institutional Funds Act. I believe 48 out of 50 states in the country actually have adopted some form of UPMIFA or another, but basically this state law gives us very clear guidance and direction and requirements for administering endowments so that they are prudent and so that those endowments maintain their purchasing power for future generations. And again, as I noted earlier, endowments are inviolate in that the gifts that are made to them are basically forever unspent. So this little illustration looks very simple, and we've tried to simplify what is a really complex process. And I'm going to walk you through it. I'm probably going to cover more information than you would anticipate with each of these little images. So as we get further into the presentation, hopefully you will have seen how this all flows together. Don't you guys love how I'm just using my hands to make motions? Like you can really see that. Sorry about that. I have to talk with my hands. This is how MCF administers endowments to ensure that we are in compliance with federal and state laws. Everything we do starts with a donor. And so much like you, we are absolutely focused on maintaining strong relationships with donors. Sometimes donors come directly to us. Sometimes they want to support a whole bunch of organizations, or sometimes we're working with a nonprofit organization that wants to grow the endowment that we have for them. And so the nonprofit comes to us and says, I'm working with XYZ donor and I'm not really sure how this works. Can you help me? So we work with nonprofit organizations, and we'll talk about how we do that a little bit later. But the donor makes a gift to the Montana Community Foundation to either create a new fund or to go into an existing endowed fund. Montana Community Foundation, for the purposes of investments, pools all of our endowed funds into a pooled investment portfolio that is managed and determined and overseen by our investment committee. We have an outsourced chief investment officer, Cambridge Associates, based in Boston. And if you're ever interested in knowing more about the complexities of our asset allocation model, or how we're making decisions, or how our investments are performing, you can always patch into one of our investment webinars. We do those typically twice a year, and those are actually archived on our website. So you can go to our website and listen to the last one and follow along on the slides and see our Cambridge associate, Omar Sanchez, walking us through, you know, what's our philosophy in establishing our asset allocations, all the way through how have our funds performed. And I'll just say as an aside, our investment philosophy takes this long-term time horizon approach. We're not timing the market. We're not trying to outperform like what's happening today. We are making sure that our endowed funds have strong purchasing power 20 years from now as it does today. So that's how we're keeping all of that in mind as we're devising our asset allocation decisions. From a practical accounting perspective, every one of our funds is accounted for separately. So, you know, you can imagine how complex how big of a task that is, considering we have 1,300 funds and they were all created at different times. They're all different amounts. They've had differing investment returns because of the duration that they've been in the pool. Any one of our fund representatives can go onto our donor portal and look at their specific fund and see how that what fund activity has occurred. So you can see contributions to the fund, you can see the investment returns for the fund, you can see distributions from the fund. So all of that stuff is in one big pool for investment purposes. Our board sets an annual spending rate keeping in mind UPMIFA and the requirements of UPMIFA, and also balancing our need to make sure we maintain intergenerational equity with the reality that nonprofit organizations rely on these funds receiving their distribution every single year. So we have set as a prudent payout rate 4.5% based on a 36-month rolling average as of December 31st. 36-month is kind of magic because that helps smooth market volatility. So in years when the market is really going strong and our performance is great, like last year when we had an 18.8% return, it's not paying out 18.8%. It's taking a look back at the previous 2 years as well and calculating, okay, what is the average of that 36-month period, and then paying out that 4.5%. Because frankly, not every year is an 18.8% return year. Some years are zero, some years are negative. And you know, we've all seen it right now with this pandemic. In March, I think our return in March for the month of March, year to date through March, was down about 18%. 17.7% was, I think, the actual number. Well, between March and now, we've made up enough ground that our investment return this year to date, is just barely above zero. So like 1.4, I think, or something like that. But I am not panicking or freaking out every single day as the market changes, because we've taken this long-term time horizon and we're looking for this year and the next 20 years. We might make some slight adjustments here and there, but we aren't making broad sweeping changes on, you know, every day or anything like that. So we pay out 4.5%, usually by the first week in March. We've done all of those calculations and you get the money from the endowment. Now I realize I probably ought to look at the slides Teal is showing as well. So there are 3 elements or 3 components to every endowment. The principal, which is the donated gift amount, the accumulated earnings, which is the reflection of how our investments in the market have done, and then the distributable, which is that portion that we send out to you for you being able to meet your great missions. So the principal is really contributions. It's the gifts, whether they're cash, securities, other types of, you know, liquidated assets or terminated planned gifts that are made specifically for the purpose intended by the fund. Our policy for creating new funds, new endowments, is $25,000. That doesn't have to happen all at once. That organizations that are creating endowments have 5 years to get to that $25,000 level. And we do count planned gifts, whether they have terminated or not, toward that $25,000 minimum. Those, as I said earlier, are all invested in the pooled fund for long-term returns. The accumulated earnings portion of the endowment reflects how our investments have performed. So hopefully they're always negative, or I'm sorry, always positive. I can't believe I said that. Practically, that's not the case. But I always do want to say, you know, they have been very strong and very positive, but we've all seen as well negative returns. And then finally, the distributable. This is the portion when we've completed all of our calculations for the endowment payout amount that is sent directly to most of our organizations. Our spending policy goal, first and foremost, is to balance the need for maintaining intergenerational equity with the need that your organizations have for your reliable, sustainable operating support that I mentioned earlier in the presentation. So historically, our endowment has earned just over 8%. We assess every single one of our funds an annual community impact fee, which is 1.25%. We take 1/12 of that every month. And then the endowment payout amount, which is 4.5%. So as you see, we have achieved this 2%, just over 2% positive return for maintaining that intergenerational equity. I'd like to cover a little bit about the community impact fees so people understand what is that all about. You might have seen us previously refer to this as the administrative fee. Community impact fee is just another way for us to articulate what this money actually supports. So the only thing any of our fees are charged is this community impact fee from MCF's operating perspective. Community impact fees for our organization cover about 3/4 of our operating budget, our annual operating budget. So this fee covers an external audit. We've had a clean audit every single year, which is pretty amazing considering the complexity of our organization and the type of work that we do. It covers our staff's ability to work with you, your board, your organization to grow your endowments. It covers our all of our software and platforms and systems that we have that enable you to access this kind of information. Yeah. So those are a few things, but it basically all goes towards supporting our operations and meeting our mission of this, creating this culture of philanthropy for Montana communities. So we've simplified our fee structure in recent years to now having basically 2 tiers. For funds under $1 million, it's a 1.25% fee. For funds over $1 million, it's a 1% fee. There are a couple of exceptions that I just will point out. One of those is scholarships. Scholarships are a lot more administratively cumbersome for us to actively administer, and so we charge a higher fee for administering scholarships, and also non-permanent funds. If somebody sets up a fund with us that is not an endowment, the money's coming in, the money might go out in the same year, those have a different fee. So, but what we're talking about today relative to endowments, this is the fee structure for our endowments. Oh, and I forgot to say, what does that actually mean? 1.25%. Early on, I used to, I wanted to make sure people understood, so I started calculating it out. And basically on a $25,000 endowment, each fund is assessed $310.45. So $25.87 per month comes from the fund to support the mission. Our endowment payout period. So just so you know, December 31st is the cutoff day for calculating, or for starting to determine the calculation for all of our endowments. I wish that we could get you those endowment payouts by February or January 15th, but it's just impossible because of the complexity of our investments. We typically don't receive our investment statements from our advisors until almost the beginning of the following month. So December 31st statements come to us the first part of February, and then it takes our team that amount of time to attribute the earnings to every single one of our $1,300 funds, along with calculating the payouts and et cetera. So by the first week in March, we automatically send out via ACH your endowment payout distribution. A word to the wise. We do this via ACH because it's most administratively efficient, and we can get those dollars out the door quicker to you, and that you can get them in your bank account quicker. It's important to all of us that if you all have a change in banking arrangements, if you've changed banks, bank accounts, whatever, you let us know by February 1st, so we can make sure that we get all of that updated in our system. Because if we don't know that, and you have made a change in your bank account, we send the money out to the bank account we have on file, and sometimes it takes us a month or more to kind of reconcile and get that money back. So please make sure on your part, you tell us if you've had a change. We pretty proactively communicate out, pretty much starting in October, asking people and organizations to update their bank account information if they've had a change. And you'll see that communication, and you've probably seen that communication coming from Kathy, and we'll continue to communicate that, but it's really important. If you want your money sooner than later, make sure we know the right bank account information. I think I mentioned this earlier, the endowment payout is calculated on the average daily balance over the last 36 months as of December 31st. It's a 4.5% payout with one exception, and that is, well, actually a few exceptions. The percentage only changes if an endowment is underwater. And an endowment is underwater if the historical value of the fund is less than the gift amount. So bear with me, but there are situations when a donor makes a gift or a new fund is established, and the market returns are negative. That's an underwater. And if they're negative enough to make the total value of the fund less than the gift amount, that's an underwater fund. We think it's important to you to still have some sort of revenue. And so unlike some organizations, we still make a payout. Some organizations that have endowments that go underwater stop the payout process. We don't do that. We do reduce the payout. It's a 4% payout. And we've chosen the 4% payout based on our experience and analysis that informs us that a lower payout amount helps the nonprofit, but is actually recoverable. We can get that fund. If what's the opposite of underwater? Above water? I don't know. Into the positive side. So then in subsequent years, when the fund is positive, you will go back to the 4.5% payout rate. So that's an example when the payout number changes. There are other ways that the payout changes, and that is if an organization says, you know what, we don't need this payout. We're doing just fine financially. And so we don't want to take a payout. We want our fund to be put on reinvest. You simply let us know, and we need to know that pretty much by January 15th. If you wish to not receive an endowment payout, that fund goes on reinvest, and the amount that would have been paid out to you goes right back into the principal of the fund, if you will. It doesn't sit in a rainy day account that you can say in a subsequent year, oh yeah, we'd also like our payout that we asked you to put on reinvest. So it's important that you understand, if you want your endowment payout on reinvest, you can't ask for it later on down the road. A safer thing for your organization might be to take the payout and then put the payout either in a separate account or just account for it in your internal accounting so you know. But if you know you're not going to need your payout and you want to see that endowment growing, this is a good way to do that. Surprise, Kathy and Teal, I didn't talk about it that way on previous presentations, sorry. We wanted to show you all a couple examples of real life endowments with us here at the Community Foundation. The first is our Helena Food Share Endowment. This endowment was created in 2001. As of the end of last year, the actual endowment is worth $244,000. Over the last 10 years, we have distributed to Helena Food Share $24,000. We have received $101,000 in contributions and an additional $100,000 in investment returns. Now you see the two notes under the contributions to the endowment slide or line item. Direct contributions, so people writing us a check or making a stock gift or something like that, where the donor said, yep, here's money for their endowment today, that's $67,000. Planned gifts are kind of a different type of gift, but when the donors decide that they don't want to take annuity payments out of a planned gift and they relinquish all rights to future annuity payments, they execute basically a planned gift relinquishment or termination, and whatever money is in that planned gift then rolls into the endowment that the donors had determined. And in the case of Helena Food Share, this was $34,000. In addition, we currently have 7 planned gifts that are active planned gifts that donors have established. The donor may or may not be taking annuity payments, but the donor has not yet relinquished their rights to those annuity payments. 7 of those, when the donors do relinquish the rights, will go to the Helena Food Share Endowment. And just so you know, under Montana law, under Montana Charitable Endowment Tax Credit, if an individual donor takes the tax credit, that planned gift has to remain intact for at least 5 years before the donor can actually relinquish their rights to those annuity payments. But gifts from companies can go directly into the endowment, so they don't have to be a planned gift. I think I probably said that before, but you'd be surprised. Right now we have about $14 million worth, it's over $14 million worth of planned gifts that at some point will flow directly into nonprofit endowments. The next example we have for you is the Myrna Loy, which is another nonprofit organization here in Helena. This endowment was created in 1989. As of December 31st of last year, this endowment is worth $846,000. Over the last 10 years, we've distributed over $300,000 to the Myrna Loy. So, it's pretty amazing to think, gosh, $25,000, $20,000, $30,000 a year, passive operating revenue coming to a nonprofit organization. It really does make a difference. You can see the contributions to their endowment of $19,000 in the last 10 years. So obviously this endowment's been around for a long time. It's earned over $600,000 in the last 10 years. We've assessed just under $79,000 in fees, and we have 6 outstanding planned gifts that have not yet terminated that will eventually flow into the Myrna Loy. So how can we help you? How can you grow your endowment? Well, I think first and foremost, every organization has to think about how important is endowment building to their operating revenue, and how important do you want it to be to your operating revenue? Do you want to be do you want to be the type of organization that continues to rely on earned income or special event income or grant applications or major gifts? Think about adding growing your endowment to the point that you can have a sustainable source of operating revenue. And if that is important to you, incorporate that into your annual fundraising plan. So, we can help you with that, making it really simple. We typically will come to, or a group will come to us, and we will do a workshop with their staff. We'll do a workshop with their board. We've walked through planned gift illustrations to show, here's what it would look like for some, here's what, and typically how I do this is Joanne actually runs all the illustrations. She does the hard part, but I make it look like I did it. No, I'm just kidding. I give her credit. But I would say, I would ask Joanne to run a dummy gift illustration, and I usually ask her to use my data. So a lot of this stuff is dependent on a person's date of birth and what have you. And so we can run a sample gift illustration, walk your board through, this is what Mary Rutherford, this is what a gift from me looks like. I'm 53 years old. A gift from me is going to look different than a gift from somebody who's 60 or 70 or 80 because of some of the actuarial tables, et cetera. But it's pretty easy and inexpensive for me to make a planned gift and support an organization that I love and care about. Our minimum for planned gifts to existing endowments is $2,500, and that's a single transaction. So one time, you can't make $500 gifts throughout the year and then ask us to execute a planned gift agreement at $2,500. You need to just kind of squirrel away. Donors need to squirrel away until they get the $2,500, and then we can do the planned gift. There's a lot of there are a lot more requirements for administering planned gifts. They're very technical. We have a liability as an organization. So, we assume that liability. You don't have to do that, but we can help you talk to your board. We can help your staff when you're working with donors who might be interested in planned gifts or growing your endowment. The last point I would make in terms of growing your endowment is probably the easiest type of gift to ask for is a bequest, because people retain control over that gift until they die, and they can change their minds a million times between now and the point of when they do die. So I'd recommend that you always include in your communication, please remember XYZ organization in your will or estate plan. Please remember our endowment at Montana Community Foundation. And if you've remembered us in your will or estate plan, please let us know so we can thank you. And if people let you know that they have left you in their will, by all means, make sure that you talk to them, make sure that you thank them, make sure that you steward them in a special way that means something to them. It's surprising how, every one of us is going to die. It's the kind of gift every one of us make is a bequest. And it's surprising how often organizations receive bequests that they never in a million years knew were coming. And we've seen that in the last year. We have received notifications from 2 different attorneys in 2 different states who have clients who have passed away, who left Montana Community Foundation in their will. And nope, it's not a gift to us for our purposes. It's a gift with very specific goals and objectives that that donor had. In both of these cases, each donor actually created a pretty large scholarship fund, and we had no idea that gift was coming. So as much as you can do to share the gospel of the importance of leaving your organization in wills or estate plans, I absolutely encourage you to do that. I guess finally, I'd say we're here to help you. And so we, before the COVID, or the Rona, as my grandson likes to refer to it, our team was, all over the state, traveling in crazy distances and a lot of miles. So I typically am driving 25,000 miles a year, which feels like a lot, to be honest, but recognizing that I'm not the only one on our team that does that, there's probably 4 or 5 of us that do regularly travel like that. 3 or 4 maybe. And we love to do that. It's a contact sport. We like to be face-to-face with our nonprofit organizations, with our donors, with our constituents. And so from Ekalaka to Libby, we're developing and strengthening these relationships. We are there to help you however you want our help. So if that's just a matter of, can you run a gift illustration and walk me through how to talk to somebody about making a gift to our endowment? We have a board meeting coming up. Could somebody make a presentation? We're here to help and do that however you'd like us to do that. Let's see. Next, my favorite is frequently asked questions. So we're getting close to the end. We have a couple slides left, but if you have questions that we haven't answered, please make sure you're putting them in the chat and staff will get to them at the end of the presentation. I don't see anything yet, and I apologize. My dogs are going crazy here. I don't know what's up with that, but so first frequently asked question is, what's the difference between an agency endowment and a designated endowment? So those of you, Kathy Novak, who knows this probably pretty well and could probably actually give this little talk, an agency endowment is an endowment over which the board of directors of the nonprofit organization decided to direct the funds for endowed purposes. And this split of agency and designated came about in recent years, probably within the last 10 years for sure, I think, thanks to our friends in the accounting world who developed this national accounting rule from the Federal Accounting Standards Board. It's called FASB 136, and it basically says that endowments over which the board made the decision to endow the funds must be accounted for separately than endowments over which the donor decided to endow the gift. So I'm going to give you a little bit of an explanation. And we take this very seriously. So for many of our agencies, for many of our nonprofit partners, we actually have agency endowments. We have over, I'm just looking at the spreadsheet real quick, we have over 100 agency endowments, and we have a heck of a lot more of designated endowments. And so how an agency endowment practically works is, let's say at a point in the year, the nonprofit board realizes, geez, we have a whole, or the executive director, but I think the board needs to weigh in. We have a whole bunch of unrestricted money left, or sitting here, or we've received a big bequest from a donor that didn't say this is what you have to do with that money. Here's $100,000 in support of Exploration Works. The board of Exploration Works might say, this was a bluebird gift, and we might be better served to make sure that that $100,000 is here for our organization forever. So we're going to endow that money. That's an agency endowment. If the board decides we want to grow our endowment, so we're going to go out and we're going to raise money, we're going to ask people to give to our endowment. And so, we might do a special event that is the proceeds of our event will go to the endowment. We're going to do a special appeal, direct mail, please support our endowment, or a campaign that says we want to have $1 million endowment. We've got a few of those going on right now. And donors say, yes, I love exploration works. I want to help you get your $1 million endowment goal. So I'm going to send you $10,000 or $5 or whatever the amount. If the donor responds to a solicitation for an endowment that you make, that goes into the designated fund because the donor decided to dedicate their money that they're giving to your endowment. So that's the distinction. We're very meticulous about when we get checks in the mail, making sure that we know whether they're agency or designated. How do you know? Well, typically, when we receive contributions, those have come to us through the nonprofit organization. But sometimes donors send us money directly for specific designated endowments. When that happens, we send a gift notification to the benefiting charity. So Exploration Works would know we've gotten a gift for the endowment for their benefit. We really, really, really encourage you to steward those donors. You know, while we're the intermediary, they really are caring about you and your long-term viability. They love you. They want to hear from you. Please steward those donors. Very few of the funds that we have under our management benefit us. We're really here for you and for the philanthropists of Montana. I would say 96% of the dollars we have under management benefit other organizations. We have our own unrestricted, our own endowment to benefit us, but almost all the funds that we have benefit somebody else. So we send you a gift notification, Another way you can tell if perhaps somebody missed an email or you didn't catch that notification that we send you is the donor portal. We have had a donor portal at the Community Foundation for a number of years. And because we are committed to making sure that we're providing the best possible tools and services available, we have recently gone through the process of upgrading our donor portal. And as with everyone and who's been through any kind of a technology change, we have worked pretty hard to anticipate challenges, problems, address those in advance, make sure that things go without a hitch. Yet, there have been a couple bumps in the road that we have communicated out to you all via email and want to cover those again today in this format. I would say overall, we're very pleased with our portal transition, but there have been a couple little things that we, again, are needing your help with. So with that, Kathy, I'm going to turn it over to you.
Yes, thank you, Mary. We really appreciate everyone's patience with the transition to the new portal. The biggest challenge for us was that everyone who was using the old portal has to re-register on the new portal. And we are sorry, there was just no way to be able to transfer over everyone's registration, everyone's record in the portal. So if you use the old portal and you have not yet registered on the new portal, if you access the new portal and try to use your old username and password, it will not work. So I want to very briefly go through the process of registering for our new portal. And Teal, take it away. So you would go first to our website and you would go to the My Fund button at the top. Now, just to forewarn you, we are going through a major redesign of our website that will be finished somewhere between the end of September and the end of October. So the design will look different, but we will still have the My Fund button and it will still approximately be in the same place so you can find it. So click on that. That will take you directly to the sign-in page. And again, every time you sign on to the portal, you can just go through our website to keep it easy. To register for the first time, you go to the register button, click on that. You want to fill out the entire account record here, and I want to just give you a few tips to keep this as simple as possible. Number one, unlike the old portal, which was completely divorced from our database, our accounting system, this portal is integrated with everything, which means that when you register, we are going to have to connect the information you give us to your own portal record or your own database record in our system. So everything needs to match. So please be very careful about typos when you enter your first and last name and your email address. Also, we know that a lot of people have multiple email addresses, but if you work for a nonprofit organization, use your professional email address, not your personal email, because that's the one we have. And if you don't use an email address we already have in our system, we are not going to be able to connect you. If you have any questions about that, you can always reach me and I'll tell you which one we have in our database. After you've completed everything, you submit with the register button. Good job, Teal. And then shortly thereafter, you will get an email from us saying, thank you, we have received your registration. After that, you need to give us a few days, usually 1 to 2 business days, for Allison, our database manager, to complete all the connecting behind the scenes that needs to happen. When that is completed and you have access to your portal account, we promise we will send you an email to confirm that you are ready to go on the portal. Please don't get impatient and re-register. If you register a second time, it will completely confuse our portal and our database, and it will make it much more difficult for us to fix that problem and get you on the portal. So give us a few days, we'll send you that confirmation, and then you'll be able to get on the portal and access all your fund information, including the quarterly statements. So thank you so much, and if you have any questions at all, you can always reach me at my email address at ccooney@mtcf.org, and that's CCOONEY@mtcf.org. Thanks.
Thank you, Kathy. We're going to get to questions now. I see a couple people had to leave. We got a little note in the chat there about that. So if you have questions, put them in the chat. I would also just remind you that we will be sending this PowerPoint presentation out to you. We'll also be sending you a few handouts, so the technical paper about agency endowments versus designated endowments, and 1 or 2 others maybe. And we'll also be sending you a survey. So please make sure that you complete the survey. It's important to us that we know if we're meeting kind of your interests, if we missed the mark, if you need more information, if there are other topics you'd be interested in learning about. We want to be respectful to those, that feedback, and we also really value that feedback. So with that, do we have any questions? Can you see any questions in the chat, Kathy or Teal or Sarah? No? Anyone have anything to ask?
This is your big chance.
As Kathy says, don't be shy. Yes, go ahead.
Don't be shy. Mary, you just did such a good job covering everything. Nobody has any questions. That's excellent. Last chance. All right. I think we're good.
Thanks, everybody. We'll go ahead and sign off, but hope you are staying cool in this sweltering heat and enjoying this beautiful Montana sun. Thank you, guys. Take care.